Alrighty, let's go to bonds issued at a premium. That sounds exciting. So, when are bonds issued at a premium? They're going to be issued at a premium when the coupon rate is greater than the market rate. So the coupon rate's 10 and the market rate's something less than 10. When that happens, everybody wants what our bond has to offer because we're offering higher than market interest. So we get to charge a little something extra for our bond because it's awesome. So as an example, Amazon's issuing that same boring 10% face value of 100,000 bond, semi-annual interest, 2 years. The coupon rate's 10%, as we already mentioned, but now the market rate's 8%. So our bond's going to be issued at a premium, and we can use time value money to figure out what that premium would be. N is going to equal 2 years times 2 semi-annual periods, or 4. I, MC Hammer says, can't touch this. Use the market rate in your calculator. 8 divided by 2, because it's semi-annual, is 4. PV is what we're looking for. That's the issue price. It's the magical number we need. PMT is the interest paid. That's fun stuff. That's going to be the same 100,000 face value times the stated rate cut in half, or 5,000. And then FV, future value, is also the face value, which is 100,000. So we're going to pop that in our calculator. Let's get that HP10B rocking. And we got 2 times 2 equals 4. That's my N. No solution. I hit the button too many times. Try again. 4N. 4I. 5,000 negative PMT. 100,000 negative FV. Why negative? Because those are outflows. PV gives me the inflow I get when I sell the bond or borrow the money, which is 103,629.89. Close enough. 103,630 is what they had using the charts. So the premium is the difference between the 100,000 and the 103,630. Or in this case, $3,630. So how do we record the issuance of the bond? Well, again, we don't do without the premium account. So we're going to debit cash for the issue price. We're going to credit bond payable for the face value. And then the difference is going to go to that premium on bond payable account. The premium on bond payable account adds to our liabilities. It's sometimes called an adjunct liability account. I've never heard it called that before. It says it in the slide, so I read it. But it would just add on to the liabilities. Then to record interest, we're going to calculate interest expense using cat's meow, meow. Calculate the interest paid, which we already did. Fun stuff. And then the difference is the amount of the amortization. So in the first interest period, our journal entry is cat's meow, carrying value times market rate. Remember, the carrying value in the first period is the issue price, and the market rate is that 4%. The cash amount is still the fun stuff. You don't have to keep doing it because it's the $5,000 we've calculated about 1 billion times by now, which is 100,000 times 5%. And then 4145 does not equal 5, so the difference is our premium amortization. Now again, there's a shortcut to get to our new carrying value, but I'm going to show you the long way. Our premium started at the 3630. The amortization is 855, which means my premium goes from 3630 down to 2775. Then my carrying value would be equal to the face value plus the premium. The face value is 100,000. The premium is 2775. So the new carrying value, which I have no room to write, let me move this baby over. 2775, still doesn't want me to write it there. There we go. So 102,775 would be my new carrying value. Rather than do it that way, we could say the carrying value in the first period starts at the issue price, 103,630, and then it moves towards face value. So we're going to take that premium amortization and subtract, because the only way I can go from 103 to 100 is to subtract the premium amortization. That's what that's supposed to say, premium amor. And that's 855. So what's 103,630? Minus 855, well, lo and behold, it's 102,775. It's that same number. And that's the number we're going to need to calculate interest in the second period. So here's that 102,775 we've calculated. And again, here's a bond amortization schedule. Notice that the cash paid is face value times stated rate. It didn't change. Interest expense is carrying value times market rate. The carrying value started with the issue price, and then it moves towards, you guessed it, face value. So each period, the carrying value is getting smaller and smaller by the amount of that amortization until we finally arrive at face value. And that because the carrying value is getting smaller, the interest is getting smaller each period as well. Though it's not shown, the interest for period 2, which would be December 31, 19, would be debit interest expense for Cat's Meow. Cat's Meow would be the 102,775 we figured out times the market rate of 4%, which gives me 4,111. Cash would still be fun stuff. I'm not even going to bother writing the numbers again because I don't want you to keep doing the same work. It's the same number every time, 5,000. And then the difference is going to be my amortization, and I need a debit to make it balance. And that's where we get the 889 premium amortization that's in the chart. So by doing the journal entry, you're effectively filling out the chart. And then if I want to get my new carrying value, or the carrying value at the end of period 2, would be the 102,775 minus the 889 amortization. That's the original carrying value there, and then the 889 amortization. And that comes out to 101,886, which is the carrying value that also shows up in our chart. So by doing our journal entry, we can get our carrying values, we can get our interest expense, our cash paid, and our premiums. All those numbers show up in the amortization schedule. And then, like all bonds, when I pay off the bond, you guessed it, it's going to be debit bond payable for 100 and credit cash for 100, because at the end of the bond's life, whether the bond is issued at a discount, premium, or par, it doesn't matter. At the end, we always end up at face value. So the book was more efficient than me. They're basically saying regardless of whether the company issues the bonds at par, discount, or premium, when we pay it off, we always pay off the full 100,000 face value. So here it is with our beautiful A equals L plus E. Just seeing that gives me tingles. And you can see that we're in balance. Assets equal liabilities plus equity, because our assets and liabilities both go down, and debits equal credits in our journal entry. Again, it doesn't matter if the bond is issued at a discount, premium, or par. We always pay back the face value at the end of the bond's life. This slide I really like because it's a nice picture of what's going on. The carrying value of a bond issued at par starts at face value and ends at face value, so it doesn't change. It's a nice flat line. If we issue a bond at a discount, it starts below face value and moves its way up to face value. And when a bond is issued at a premium, it starts above face value and moves its way down to face value. So we're always moving to the same place, which is the face value of the bond. At maturity, the bond always ends up at face value. Zero coupon bonds are bonds that don't pay periodic interest. So instead, zero coupon bonds are given a very large discount because the coupon rate is effectively zero and the market rate's going to be greater than zero. So there's a bigger discount to make up for the lack of interest. So if you're trying to calculate the issue price of a zero coupon bond and we're using our calculator, PMT would be zero. That's the biggest difference because no interest is paid periodically. So our PMT is zero, which means the present value of the principal is the issue price of the bonds. That is the present value of the face value, because that's all that we would be getting. At the end of the bond's life, we get the face value back. So why the hell would I lend somebody $100,000 to be paid back $100,000? Well, I wouldn't, because I want interest. So I'd lend them like $90,000 to get back 100. And when I get back 100, 90 grand of it's for what I loaned, and the 10 makes up for the lack of interest. So all you really need to know is, from a vocab standpoint, zero coupon bonds are bonds that don't pay interest periodically, and as a result, they're sold for a deep discount. You may notice in the textbook it talks about straight line amortization. No company uses straight line amortization because it's not allowed under GAAP, so we don't go through it. We're not going to hold you accountable for it on any exam or quiz that we have. But I left it in here just to tell you that effectively during the lecture.